once you're below 4,000, at this point between 4,000 and 3,500, it becomes a rounding error. I believe gold is going to 10K, probably at the same time as silver's at 200 or so. And so if that's the case, what does a few $100s mean at that point? In other words, once we're below 4,000, as we go down, I'm just going to have buy orders every $100, a little bit, a little bit, a little bit, and just start accumulating for that longer term horizon move that I do see coming. Obviously, I'm looking to be a buyer on gold around 3,500, and we'll look at that in a minute. But silver around this $50 level, we're now getting in a range where I feel comfortable that it's at a discount to where it should be over the longer term. And I'm starting to get very interested in being a buyer. I think that's where the fundamentals over the next year or two start bringing silver back up towards the 90, 100 level, eventually taking out 120. And I still think 150 within by 2030, 20, even $200 is very doable on silver.
Quick favor before we begin: if you enjoy this video, don't forget to like and share it. Every like and share helps YouTube recommend this video to more people, which really helps the channel grow.
Gareth Soloway says investors should focus less on short-term noise and more on the bigger picture forming in precious metals. According to him, once gold drops below $4,000, the gap between $4,000 and $3,500 matters less to long-term buyers. He sees gold eventually climbing toward $10,000, while silver may reach $200 in the years ahead. Soloway explains that he would not try to catch one perfect bottom. Instead, he would place small buy orders at $100 increments as prices moved lower, slowly building a position for a major long-term move. He also sees silver near $50 as a discount compared with where he believes it should trade over time. With fundamentals improving, he expects silver to move back toward $90 to $100, then break $120 and possibly reach $150 to $200 by 2030. For investors, his message is patience, discipline, and accumulation. He stresses that scaling in can reduce emotional decisions and keep traders prepared for opportunity during volatile metals markets. Now, we present the clips from Gareth Soloway's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The key here is, and listen, I know I upset people by talking about it going down to the 50-ish level, give or take. Number one, it's almost there, and I'm starting to get ants in my pants to buy silver, right? So the first key level is this pivot point here at 54. That'll be first support. I don't know if it will hold, but that'll be starting where I start to nibble. And then really at a pierce of $50, that's where I want to buy. Now, the rebuttal I always hear, right, is that, oh, but, inflation adjusted, silver should be so much higher. You're 100% right. But remember, folks, silver, gold, that in the short term, things move on emotion, which is right now fear, and that drives price below where it should be. And just like greed, when we were at 120, you could argue that it shouldn't have been up there that quickly. Longer term fundamentals absolutely matter. And so, again, obviously, I'm looking to be a buyer on gold around 3,500. We'll look at that in a minute. But silver around this $50 level, we're now getting in a range where I feel comfortable that it's at a discount to where it should be over the longer term. And I'm starting to get very interested in being a buyer. So I think that, again, you get in this 54 to 48 range or so down in this range. And by the way, where am I getting that lower range? That would be revisiting our 1980 highs as well as our 2011 highs. And just in terms of a quick lesson in charts, when you have a trend line that is hammered on in technical analysis and it finally breaks out, there's this inevitable want for it to come back to home base. Think about a kid who goes away to college and then they come back and live with their parents after college, or they come back for Thanksgiving or Christmas, right? There's just that inevitability that it oftentimes comes back to that level. And that's what silver's doing. Very normal human psychology reaction. After that, we start our next trek up. I think that's where the fundamentals over the next year or two start bringing silver back up towards the 90, 100 level, eventually taking out 120. And I still think 150 within by 2030, 20, even $200 is very doable on silver. Again, I'm not looking for these parabolic moves like we saw here, but just fundamentally, you can make a case that eventually it revolves around that 150, maybe even 200 level. When I project out so far, right, 4 years out, 3.5 years out, it's so hard to really know. It could be by 2028, 2029. I'm not expecting silver to just rip up to 120 again after it gets to 50, right? There's a lot of technical damage. People that bought in at 100 are going to be panicking when it gets back to 100 to dump into that and say, thank goodness I'm back to my break even. That's human psychology as well. When we get crushed on a trade, we're just happy to get out break even, and you will see some of that. So it's going to have some work to do to get back to the upside. But I do think, again, once we get up there to that 120 level and break out, you'll see 150 and 200 very, very quickly again. But again, I'm giving myself a little leeway on this call, Michelle. Let's give it till 2029, 2030. That's really only 3.5 years away. It's not that far away. Yeah, so gold, if we look at the chart here, this did come into some key support. So notice this beautiful trend line, high pivot here, low, support, support. Every time it hits this line, it's getting a bounce. And we have this beautiful downsloping trend line. And so what this is creating is what we call a wedge pattern. Wedge patterns squeeze price tighter and tighter until it explodes in one direction. Now, listen, if it breaks above this trend line, which currently sits around 4,300, then I honestly might say to you, we might not get to 3,500. We might have broken out. But on the vice versa side, if we break this 3,090, 80 level here, we probably trade down to this major support at 3,500. To me, that would wash out the weak hands that we were just talking about, people that bought gold thinking it was a get-rich-quick meme coin, when in reality, it's an insurance policy against all the crazy stuff we see with fiat and these governments out there. But right now, I'm still leaning towards the downside. I don't think we've been fully flushed out on gold yet. And I will say this, and we talked about this just before we went live, Michelle, is that once you're below 4,000, at this point, between 4,000 and 3,500, it becomes a rounding error. I believe gold is going to 10K, probably at the same time as silver's at 200 or so. And so if that's the case, what does a few $100s mean at that point? In other words, once we're below 4,000, as we go down, I'm just going to have buy orders every $100, a little bit, a little bit, a little bit, and just start accumulating for that longer term horizon move that I do see coming. And again, how do you not like physical gold? I mean, physical gold is the way that for thousands of years, people have said this is real wealth. Governments have come and gone, civilizations like the great Rome has come and gone, and you still have gold as a store of value. So I think from now on, you below 4,000, it's a buy. It's so interesting. It's to me, it became a risk on trade. And it's never meant to be a risk on trade. We would see NASDAQ up, gold jumps up significantly, right? In fact, if you look at, the highs here, it kind of coincides with earlier in the year on the S&P or the NASDAQ. If we look at the NASDAQ, you go back to earlier this year, we were kind of right up in that upper range too. And so I really look at gold and just say, hey, listen, people again bought it for the wrong reasons. They saw it just ripping, and they bought into the narratives that were being spun, which, by the way, I believe in those narratives. But it hyped up too many individuals to jump in. And again, it was all those reasons, central banks buying, et cetera. And it just pushed it up too much. And there's this, what we call a rubber band effect in charts, where when you pull that rubber band, the tighter you pull it or the further you pull it, when you let it go, it snaps back. And so if you get a bunch of people to buy into gold at the highs, 5,000 or above, and then all of a sudden the bottom drops out, those sellers then are going to push it down significantly. And I think that's what we've really seen here. We've seen, again, the risk on trade has been deteriorating. We've seen less and less. If you look at the stock market breadth, it's been more and more negative, even though you still have a stock market near all-time highs. We know it's just a handful of stocks at this point keeping the markets up, and gold is reflecting that. Now, eventually, I think gold flushes out those weak hands like silver and becomes a risk-off trade, where people start buying it again and pushing it up as the stock market comes down.
In this interview, Gareth Soloway breaks down the key levels he is watching across silver, gold, and the broader markets. He explains why silver's pullback toward the $50 area could create a buying opportunity, how long-term fundamentals may still support much higher prices, and why technical psychology matters after a major rally. Gareth also walks through gold's current wedge pattern, the levels that could confirm a breakout or trigger a deeper flush, and why weak hands often need to be shaken out before the next major move begins. He connects the metals trade to broader risk sentiment, market breadth, and the handful of stocks holding up the indexes. He also explains how fear, greed, and the rubber band effect can pull prices away from value, only for fundamentals to eventually reassert themselves. This conversation is packed with chart-based insight, macro context, and a clear look at where precious metals could be headed next. Let's get into the interview.
I think what we need to see is a flush out of what I call the weak hands, right? And this goes with gold as well, is that when you had people jumping in because they thought it was a get rich quick thing on silver and gold when it was going parabolic every single day, those people need to be flushed out. The old school, and I, not to date myself or whatever, but those of us that have been in gold and silver since the teens, the early 2000s, we understand that gold is a safe haven. It is meant as a hedge against inflation, against the US debt continuing to climb, and eventually it will play out in the long run, but we can't expect it to go up 100% every single year, right? I mean, that's just not the way it's going to work. So I 100% agree with you. The fundamentals say eventually up, and I agree, and that's why I'm looking to buy in this lower $50-ish range. But at the same time, the fear of people that are stuck in this trade. I mean, think about how many people bought between even just $100 and $120 that are now feeling the pinch, that are getting ready to throw in the towel. And so that's the fear. The fear is it's not the sexy trade anymore. It's got to be dumped. They're going to eventually throw in the towel. And when they do, that's that final flush out. We get a bottom and then we start trading back. I think this, by the way, I think by year end, we're back to $75 to $80. So there's actually some really good upside in silver here. It's just you got to get rid of these weak hands. The physical delivery is so important. So many people buy, and now we have these perpetuals on stocks and even on Bitcoin, and it allows people to basically trade the underlying asset without actually owning it, right? I mean, without actually having the physical asset in their hand. And I think that, again, if you could get rid of that, then these metals would instantly be up significantly. I don't think they're going to get rid of it, unfortunately. It looks like they're trying to. The other thing I'd point out, too, is don't think that there's no nefarious kind of action going. And I talked with Andy the other day about this, and it was fascinating, and I agree with him, is that if you're a central bank, if you're a country, you don't want silver at 120 if you're buying a ton. You want it down. So you're going to do your best. And we still see central banks buying gold and silver, but they would much rather buy it at a discount and load up and get retail scared and dumping so that they can kind of swallow it up. And I could absolutely see that as being part of the issue here. So there's lots of things going on. We see insider trading. I mean, even on Micron, yesterday at 310, it was at 990. And for the rest of the day, it soared back up to 1050. And then miraculously, the earnings popped it to 1250 today. There is insider information leaking out in every which way at record numbers. Not saying it hasn't happened before. It's always happened, but it's so obvious now in the charts. It's at such a magnitude that in silver and gold, I'm sure there's some of that where let's put some negative stuff to push price down with retail, scare them out as we just buy up underneath. So if you're a long-term investor, just focus on the fundamentals. The fundamentals is golden down the road. That's where you got to look.
The move in silver and gold is not dead. It is going through the kind of reset that markets often need before the next real leg higher. When prices run too fast, too many people jump in for the wrong reason. They are not thinking about inflation, debt, physical demand, or long-term protection. They are only chasing a quick win. When that excitement disappears, those same buyers become sellers. That is why this pullback matters. It can clear out the emotional money and bring the market back to stronger hands. For long-term investors, the bigger picture has not changed. Gold and silver remain tied to the same major themes: rising debt, currency pressure, inflation concerns, and the importance of owning real assets rather than trading paper. There may also be bigger players using fear to their advantage, especially if they want to accumulate metals at lower prices. So the lesson is not to panic with every drop or get blinded by every rally. The smart move is to watch the levels, respect the risk, and stay focused on fundamentals. What do you think? Is this just a shakeout before silver moves higher again, or is the market warning us of something bigger? Drop your thoughts in the comments. And if you found this breakdown valuable, like the video, subscribe to the channel and turn on notifications for more market updates.